Now, still on the aftermath of the OPEC meeting, joining me online from London is Gregory Kronsten, the head macroeconomic and fixed income research at FBN Capital. Thank you so much, Gregory, for taking the time out to join us. So let's just talk about what Nigeria's response has been so far to the falling oil prices. Now, the finance minister has made it very clear that the country is prepared to tackle oil prices at the current levels and even lower with some macroeconomic measures. Well, she said this could include reviewing policies on investment incentives and waivers. How far-reaching do you think this will be for fiscal revenues and overall economic growth?
Right. Well, thanks, Esther. Mrs. Ngozi has set out several scenarios, or her team has. So the current scenario is $73 per barrel for 2015, and they created TILO and maybe a third one as well. So, I mean, the starting point, which should really be what measures are. So, the selection measures, and as always, the ones that have the most short-term impact on the expenditure side. So, there are various things here, like sort of cutting overseas travel, cutting ghost workers, although that's ongoing. Then, of course, there's the lower cost of the fuel subsidy, right, which in next year is set for petrol for 500 billion naira lower. Then they even get rid of it altogether, we hope, of course. So on the expenditure side, there's various agendas, but, you know, they're going to go so far, and which, you know, so the lower scenarios for the oil price of, let's say, 60, I mean, to go that far, it's very challenging because so much of the spending is recurrent spending, i.e. personnel, wages, allowances, overheads. And, you know, any government in this situation, anywhere, first thing you do, of course, is you've got capital. You've got capital spending because it's far easier, because the projects haven't been started usually. And it's very hard to cut people's wages because you know that people don't like that and you get protests. Also, if the elections are coming up. So, I mean, there's only so far, in my view, they can go on expenditure. On the revenue, there's a lot more they can do, but, I mean, that won't feed through immediately. You know, there's higher targets for the revenue service, FIRS. Yes, there's plenty more tax that could be collected, but the impact of that, as I say, there's a lag effect for the impact. Okay. So, yeah, I mean, the signal's been very good signal given by the CME, of course.
Okay, Gregory, if I could just come in here, Gregory, do you think also perhaps to boost the revenues that will be coming in from 2015, we're not sure where oil prices will settle eventually, but I mean, going by all the analysis that's been done and predictions, it doesn't look like oil prices will at least go back to where they were at the beginning of the year. Do you think that the Nigerian government could go borrowing?
Well, that's a very good question. I mean, I think that's probably the last resort. And, of course, the debt ratio, the external debt ratio is extremely good. So, yes, of course they could borrow. I mean, in the external market, borrow Eurobonds, borrow from donors, borrow from bank consortia. All that's a possibility. But that's a last resort because the CME, of course, has a long memory of the old days when there was all the unpaid Paris Club debt, and she's very keen to preserve these ratios. But, you know, if push comes to shove, yes, you know, that has to be considered.
Okay, Gregory, let's just quickly talk about OPEC now. Now, some analysts say that OPEC's strategy could be to have oil prices go lower to a level that would make production unprofitable for North American producers. What's your take on that?
Well, yeah, I think, look, that's the agenda. And the Saudi agenda and also its allies in the Gulf. I mean, their thinking is that you know, they maintain their production, OPEC maintains its production, everybody else does, including Russia, and the prices reach a level which is uneconomic for most shale oil producers to continue. But you know, there are very different figures here for what their break-even cost is. And Mrs. Ngozi, I think, said $75 yesterday per barrel. But if you look at the MPC has their communique has a range of 52 to 70. So it's a question of, you know, how far low they have to go to have an impact on rising shale oil production.
Okay, Gregory, let me just come in here. Now, let's say that OPEC gets to a point where oil prices get so low and become unprofitable for these North American producers, and then we see them reining in some of their output. and then oil prices go up. Wouldn't they come back to the market as soon as oil prices go up?
Yes, according to sort of textbook economics, they would do. But there's two things to remember here. One is that a lot of the shale oil producers are very indebted. So, they're spending far above their cash flow. That's one thing. And the other thing is, as I understand it, the nature of shale oil production is that you work on the sort of cheap side of one prospect, then you extract the oil and the gas from there, then you move on to the next one, which of course requires more capital spending.
All right, let me just ask you this one last question, Gregory. I've asked other analysts also, where do oil prices go from here?
Well, I mean, this of course hinges upon whether Saudi strategy is going to work. I mean, our view is that I think short term we'll have to go a bit lower. Short term we have to go a bit lower, but thereafter, we should see a recovery. But recovery, we're not talking about $110 a barrel as we had earlier this year. I mean, currently we're forecasting average for next year of 90. But that, of course, there's a lot of movement within the year, so I'm not saying we start the year at 90.
All right, thank you so much, Gregory, for talking to us. Some might say that that's a little too optimistic for oil prices, but of course we'll keep our fingers crossed on that.